Annuities, accumulation annuities, safe money annuities. We're going to be talking about annuities today and what you need to know about annuities. Hi, I'm Charlie Thompson and I'm here with Jeb Bradshaw. He's the president of CLA USA. We're going to be having him do a quick overview of these annuities, and then I'm going to come back and I'm going to ask him questions that we get asked every day because people need to know. People want to know. So first of all, Jeb, welcome, and I want you to just give them an overview of these annuities and what it means and what these different terms mean.
I'd love to, Charlie. One of my favorite topics, and I've actually brought a few notes along. Most importantly, today we're talking about fixed annuities, not variable annuities that have exposure to the market. Variable annuities have market risk. Fixed annuities are guaranteed. When we talk about fixed annuities, we typically talk about safe money or even accumulation annuities. And let's talk about the safe money annuity first. There's four important features we want to cover when we're talking about traditional fixed annuities. First and foremost, protection from losses. Your principal is guaranteed never to go down. Earning a competitive interest rate. Liquidity features that give you access to your money. And of course, with all annuities, the power of tax deferral. Now, when we use the term accumulation, we're typically talking about indexed annuities. The indexed annuity market has literally exploded over the last 10, 15 years, and with good reason. What is an indexed annuity? An indexed annuity is a fixed annuity. The only difference is the way it credits interest. Rather than earn a guaranteed interest rate as with a traditional fixed annuity, it has all of the features that I mentioned before: principal protected from losses, earning a competitive interest rate, liquidity features that give you access to your money, and the power of tax deferral that all annuities have. But what it does differently is it credits non-guaranteed interest based on an underlying index, typically the S&P 500, but there are other options. So with index annuities, we have the potential to make more than fixed rates by virtue of this underlying index.
You know, Jeb, that sounds complicated. So go ahead, tell me how all this works.
Well, it's really not that complicated, Charlie. In fixed annuities, like the indexed annuity, 100% of the money you put in that policy or that contract, and we'll use those words interchangeably, 100% of it goes to work for you, and 100% of it is guaranteed never to go down, never to lose money. At the same time, your potential returns are based on the upside potential of the market. Again, that underlying index. We mentioned the S&P 500, one of the more common indexes out there, being the most common in these policies and contracts. You get a percentage of those, that upside turn in the market. You don't get all of it. If you want all of it, you got to be in the market. And if you're in the market, you got to be able to take losses. But you get a percentage of that over a particular period of time, typically 1 year, but the period could be longer. But here's the kicker. Every year, or whatever period your contract stipulates, you lock in those gains. You lock them in. You not only lock them in, but you reset. So let's say the market went down a lot. You're locked in. You don't participate in the losses. And we use the term reset. It has a reset feature. So for the next period in the contract, you have reset at that new lower period. You didn't lose any money, and you could also start at that lower period. Some people refer to that as a ratchet as well. You know, the ratchet tool. It can go one direction, but once it's locked in there, it can't go backwards. So two important things to mention. You don't lose money, not a dime. And your starting period for that next period is at that lower level.
I'm going to stop here and give a little more in-depth explanation of how the ratchet effect that Jeb is talking about works. On this first screen, you see where your initial account value goes up in value the first year. For the ease of understanding this video presentation, we're assuming that the market went up and your account value went up also, as you can see. This second screen represents year 2, and the assumption here is that the market went down, the red line, as you can see in the graph. But because of the ratchet effect, Your account value did not go down but stayed level. You lost no money. This third screen shows year 3 and that the market again went up, but not even as high as it had been in year 1. Your account value also went up the appropriate amount, but as you can see, it is even higher than it would have been if you had taken the loss in the market. The final screen shows year 4, and again the market takes a loss, even lower than your initial account value would have been if you had been exposed to market risk. But again, the ratchet effect keeps your account value level and protects you from losses. Okay, the next question. Can I take my money out of these annuities?
Absolutely. Actually, fixed annuities are fairly liquid, a lot more liquid than bank CDs, as an example. Almost all annuities have an annual withdrawal, up to 10% of the account value, typically, that you can withdraw, penalty-free, every year. Let's say you're in a situation, maybe a medical situation, where you might need more than that 10%. You might even need all of the account. There are features in some annuities that will allow for that. Should you meet that requirement, being confined to a facility, as an example, you would have access to much more than that 10%, maybe even the entire account, as I mentioned.
All right, here's the question that we get all the time, and you know it, you've answered it so many times. What are the costs and the fees to annuities?
Well, Charlie, there are no fees, and there are no direct out-of-pocket cost with fixed annuities. Bank CDs, what's the fee you pay for a bank CD when you go get one at the bank?
You don't pay anything.
Right. Well, annuities are the same way. 100% of your money that goes into a fixed indexed annuity goes to work for you immediately. Not a dime comes out for fees.
Okay, Jeb, I like your answer. No fees. But now the next question that we do get all the time. Can I lose my money?
Absolutely not. The fixed index annuity can never lose money. The indexed annuity is really as safe as the insurance carrier behind it. And insurance companies, it's important to note, have reserve requirements that are actually more heavier than banks have, or the FDIC has on banks. No index annuity owner has ever lost money because of the failure of a carrier. Now, it is important to check the strength and the ratings of your carriers when you're looking at an indexed annuity.
You know, Jeb, you've covered a lot today, and I just want to do a quick wrap-up of what we've talked about so that it's easy to remember. We talked about it sounds complicated. It is not complicated. These are very simple transactions. We also talked about, can I get my money out of these annuities? Yes, you can. That's a great answer, yes. Well, what else do you have to say? Another question was, what are the costs and the fees on these annuities? There are no costs. There's no cost when you go down to the bank to buy a CD, and there are no costs in these. The last question is, and it's an important question, can I lose my money? No, you can't. That's the best answer of all. No, you can't. But there's also some upside to these that are better than CDs, which we just talked about. You stand the potential to make much more money with an annuity than a CD, and it's based on the simplicity of the index.